Thanks for tuning into the Portfolio Manager. I'm your host, Niraj Shah. Our guest today is Rajesh Cheruvu, MD and CEO of LGT Wealth India. They run an overall AUM of close to 800 odd crores. We talked about a subset within that based on the kind of allocation that they've done, and very interestingly they have a fairly decent size exposure to mid caps and large caps, suggests that they're looking at bottom up stories and not necessarily phased or two-phased by what the commentary around mid caps and large caps or mid caps and small caps is. Our guest is Rajesh Cheruvu, as I said, MD and CEO of the fund. Rajesh, good having you. Thanks for taking the time out. At the outset, can you tell us a bit about your approach? I mean, are you bottom-up value investors? Do you guys believe in growth? What's the investment style?
Yeah, just if I need to start with my investment philosophy and investment approach, Niraj, we are predominantly growth-oriented investors. And in terms of the construct of the portfolios, we do it more of a bottom-up basis. We do. In terms of philosophy, the philosophy and objective of this particular strategy is focused towards investors who are having actually medium to longer term horizon. And our objective is to generate returns superior to nominal GDP growth over 3 years plus period of time. How do we do that? I think primarily focusing on structurally compounding businesses and keeping volatility in stock level as well as portfolio level under check. So this is our actually focus in terms of designing and constructing the portfolios.
Interesting that you're not shying away from having more than a 55% exposure to the mid space, Rajesh, while you talk about wanting to control volatility. So how is this exposure coming through? I'm not saying it can't be done, but it's interesting at the current time. So tell us a bit about this exposure to large, mid versus small.
Yeah. So this is largely in terms of stock selection. That's where we, while doing the stock selection itself, we do the whatever actually the in terms of the quality of our investment approach has about 4 factor. That is a 4 factor. The 4 pillar. It is built on 4 pillar. There is a QSGBA approach. We call it as QSGBA framework. Quality, secular growth, and secular growth, valuations, and active management. So these are the 4 pillars we use in terms of while constructing portfolios. Quality is, I think, in terms of quality of the business, quality of the balance sheet, and quality of the management. So this, when we are actually focusing on quality of the business and quality of the balance sheet, that's where I think just we could able to identify certain actually the names which are actually transforming from, I think, from benefiting from the transformation from informal to formal, and whatever actually themes going on in the marketplace, whether it is a consumption or whether it is formalization or indigenization. So that's where I think we tend to actually identify certain mid and small cap names. So that's where I think it is coming in from. Since we are actually doing in-depth analysis of corporate balance sheets for about 20 years plus data, we actually scrutinize it. This we do it every year, year-over-year basis we do it. And we categorize companies into three types. One is crown jewels, war horses, and treasure hunters. So this particular strategy is largely built around war horses and predominantly around war horses. War horses are companies which are offering superior growth with objective to actually gain the market share from the market leaders. So that is the kind of actually businesses. They bring in P multiple rating plus earnings growth. So that's where you see more and mid and small cap orientation in this, but there is not a fixated one that actually changes with time to time. So off late, actually, just we are actually been the portfolio. What you are looking at is 31st March. I think as time passed by, actually we have been increasing large cap because we are seeing some certain opportunities in large cap, especially cap goods space. We are actually adding certain cap goods names in the ongoing correction.
Oh, okay. You're adding some large caps in the cap goods space and the ongoing correction. Okay. Okay. Here's the deal. Here's the question then. Financials form 31% of your portfolio as of 31st March. Materials about 9, industrials about 9 odd percent. Would cap goods fall within this bucket, and therefore has this overall exposure of either industrials or materials gone up from the 9% odd?
This industrials space actually just we are increasing even further.
You are increasing it further.
We see, yeah, because we are actually seeing a reasonable amount of activity there in terms of private capex is actually picking up. So we have been waiting for a right opportunity to add, as I mentioned. Part of our 4 pillars, margin of safety, our valuations are actually quite important. Despite companies having great quality balance sheet or great quality business, valuations should also actually augur well for that particular business. So we are seeing the Nifty has given about a 3 or 4% at index level, but individual stocks we have seen certain opportunities and we are actually started building.
Okay, one more question really. I mean, when I look at industrials or cap goods, the blue chip names, the MNC ones are all, to some people, priced to perfection. Even if not to perfection, certainly priced high. Right? There was a downgrade by Nomura on ABB, I think on Thursday, so on and so forth. So when you are buying into large cap good names, where you might see value, is it value in growth, or are you actually buying the non-blue chip names because their valuation multiples might be lower? Just trying to understand.
Yeah, these names might not be non-blue chip names. They could be, but bill to book ratio in terms of quality of balance sheet and quality of business are quite robust. But they might not be blue chip names or MNC parentage. They might not be having MNC parentage. But bill to book ratios of these businesses are quite good, but valuations were not earlier, were not comfortable. But now I think with whatever business updates been released of late, I think we are seeing 2 to 3 years perspective. These businesses are offering reasonable amount of growth in terms of runway to growth, plus valuations also are 18 months to 2 years forward basis. These companies are looking attractive. So we started actually using this ongoing correction.
Got it. Viewers, some interesting focus to consumers as well by this fund. So consumer discretionary is 24%, consumer staples is 6.7%. Now, before I ask Rajesh about what the pockets out there, let me get in my colleague Mahima to give us some sense of what's expected in the quarter from some of the consumption names. Mahima, give us a brief piece of what the brokerages are thinking about the consumer space for this quarter.
Right, Niraj. So I start with how the demand will pan out to be. Well, in terms of demand, we're expecting a subdued performance. Well, we'll see some kind of gradual recovery. However, a quick rebound is not expected in terms of demand. Now, in terms of volume growth, we'll see some kind of divergence as in terms of volume and value growth, because volumes are expected to come back to a normal stage where they'll grow in an average mid-single digit level. In terms of margin expansion, well, the commodity inflation is kind of easing, so the margins will sustain at the same levels as they have been in the past quarters. However, gross margin expansion will likely be slow, because a lot of FMCGs are now making reinvesting the profits that they're earning into product innovation, distribution expansion, and marketing spends. And lastly, in terms of rural recovery, what you can see is that rural recovery might be a bit dented, because the high inflation has really hit the income levels of the people in the rural area, and so rural recovery will basically depend on easing of inflation, one thing, strong festive season, and higher government spending ahead of the elections. So this is the overall view of the consumer sector.
Thanks for that, Mahima. Interesting breakup there, Rajesh. I mean, staples 6.7%. I would reckon it's not exactly overweight. Would you be kind of circumspect there? And part 2 of my question is consumer discretionary. That's a very aggressive 24% weightage there.
Yeah. So consumer discretionary, I think we are quite optimistic over next 4 to 6 quarters basis, Niraj. There actually segments, if you look at the consumer discretionary is a headline index industry sector. But if you look at the subsegments like the EMS or the hospitality, so these segments are the high value consumption names. If you see, I think the whatever slower volumes volume pickup or volume growth is happening in a low value segment, whereas in high value consumption, still volumes still holding robust, including jewelry, hospitality, etc. So we are actually just optimistic in that space. And EMS is another area which is actually getting benefited out of ongoing indigenization spree. And the whatever heat wave, I think they expected to actually rise even further. Temperatures are likely to rise even further. So with that, I think manufacturers of air conditioners or EMS manufacturers supplying to these branded air conditioners. So this space actually just we think can this quarter as well next quarter will actually augur well for these companies.
Is EMS within that pocket the strongest bet, or is there something else? QSRs, the online players, what is the strongest bet?
Yeah, QSR, we have some nominal exposure, but we think, I think that is at least 2 quarters away in terms of recovery there, QSR space. We have very nominal exposure. Predominantly, I think EMS and hospitality are actually.
EMS and hospitality. And by hospitality, you mean hotels predominantly?
Hotels, yeah.
Hotels predominantly, okay. Yeah. Some more upsides there. Well, viewers, there was a Kotak note which said that Feb rates, tariffs have moved up to average of 9,000. EBITDA revisions being done for FY25. And here we have Rajesh talking about how they are very constructive on hotels from amongst the consumer discretionary, in addition to EMS, which is the back-end manufacturers of electronics, the likes of Dixon, Amber, etc. They need not necessarily be the stocks in his portfolio, but I'm just giving you a nature of what the EMS players could be like. Rajesh, I don't want you to comment on specific stocks, but I'm using them as an example. Yes. So in your top allocations, there is a Varun Beverages, there is an Astral. I mean, significant weightage is there. They're not exactly cheap in terms of headline valuations. So is there merit in growth that you're seeing? I mean, do these form a part of consumer discretionary per se for you as well?
Not necessarily, Niraj. These names, in terms of our portfolio construct, actually, if you see the way how we construct portfolios, as I mentioned, 4 pillars of my investment approach. 4th pillar is active management. We segregate portfolio into 3 parts: core, tactical, and satellite. There are certain names actually form part of my core allocation. There, I think just if there is an opportunity, I add additional tactical allocation to those core names, which these names we tend to hold 3 to 5 years kind of horizon. And there is a price opportunity in terms of short span of time. Actually, stock prices move ahead of fundamentals. We release some amount of capital from those names. That's how I think we play tactical in and out in those names. Whereas satellite is companies which are actually showing some amount of fundamental improvement or change of management or business. Overall, I think business fundamentals are improving, etc. So we actually start as a satellite allocation, and if they give good price opportunity, just will actually seep into the portfolio gains, and eventually, I think these from near-term fundamental improvements, I think they become more secular, and I think they turn out to be secular and steady growth companies. Then eventually they could become core allocation. That's how I think our approach, overall portfolio construct approach. So the names, whatever you have shown, or most of them are actually my core allocations at this point of time. From there, actually, I don't find any actually other than Varun. I don't have any consumer names there. So most of them are actually whether it is part of the industrial allocations or BFS allocations. Yeah, Varun is actually part of our consumer staples allocation. Discretionary side, we don't have any names from this.
Got it. Fair call, yes. And you could argue that Varun Beverages, in some sense, it's consumer staples valuation certainly, but the growth numbers for Varun have been anything but how staples growth numbers have been like. But point well taken, Rajesh. Financials, you mentioned that 31.4 would mean slightly underweight. I just wanted to know the breakup there. Are you into lending financials like banks predominantly? I see a bank or two here like Axis, etc. Or is it NBFC lenders? Again, I see a Bajaj Finance. Or have you moved? I mean, do you also have a larger sprinkling of non-lending financials?
So, our BFSI exposure in this portfolio dominated by lending businesses. We have 2 housing finance names also, which are actually just below this top 10 allocations. You'll find it. 2 housing finance names, predominantly affordable housing names. There we are actually seeing growth is quite good, and return ratios have been good, and they're actually the stress in book is also in quite controlled manner. They have been managing it. But good quality businesses and good quality management. We have 2 housing finance names, and this NBFC, as you have shown, that is also part of our portfolio. And banks, we have 2 banks. This one as well, one PSU banks, India's largest PSU bank, also there in the portfolio. But PSU banks actually just we believe more or less big gains are behind us. from here onwards, I think their returns should track their earnings growth because provision reversals or actually the whatever multiple rating is more or less done for now. So we are actually just easing gradually the PSU banks.
Got it. Rajesh, just one curious question. A lot of these names are large, and I still see a 50% allocation to mid caps and small caps, even if you started buying into large cap goods, right? So where is this 50% hiding? What sectors, what themes, where is the bottom up idea?
So those are all actually like the names I mentioned, affordable housing finance in BFSI space. Yeah. Similarly, within consumer names also, you will find a couple of one of the panel companies part of the portfolio. Yeah, one of the actually unique tire manufacturer, which is actually off-highway tire manufacturing companies there, which we used to have a significantly overweight there, I think around 6%, given the ongoing Red Sea logistic challenges and constraints, we have reduced significantly to around 2.5-3%. We hope, I think, but profitability wise, this company holds strong moat and profitability is quite superior compared to any other tire manufacturer. Like these kind of actually names, you would find it there.
Point well noted. Okay. Well, IT also forms well, 9.7%. So in some sense, slightly underweight relative to maybe the indices. But let me first get in my colleague Rucha to tell us what to expect from IT after the slightly subdued performance by TCS and before that a month ago by Accenture as well. Rucha, what's happening in that space? What's to be anticipated?
So as you rightly mentioned, Niraj, the street was expecting something incremental from the TCS management's commentary, but there was no hope of recovery of demand from the management last Friday. The uncertain macro environment still prevails, which leads to clients cutting down on their budgets due to pressure on discretionary spends. Also, there are a number of shorter deals, right, rather than long. So there are less number of shorter deals rather than the long-term deals, which have an impact on the pricing as well, and which can affect the margins of the companies as well. Also, the hyperscalers are also cutting down on their workforce, which again indicates that there is no near-term demand visibility. Like Google did cut down on its workforce less than 6 hours ago. As you rightly mentioned, global peers like Accenture as well cut its FY24 guidance to 1 to 3%, which is a very small range as compared to the previous range of 2 to 5%. However, on the flip side, there can be two positive aspects to this as well. Number one, the EBIT margins are being sustained as the bench which was created in the last few quarters is now coming into utilization. And this has led to lower subcontracting costs, which is a major expense for the IT company, and reduction of the same will help the company support their margins. Also, attrition is normalized, but there is a hiring freeze across the industry. So there are mixed views onto where the IT is going, and apparently I think the clients are just waiting for the elections to happen and to figure out where the demand will ultimately go, because nobody is able to comprehend about the near-term demand as of now.
Okay, well put, well summarized, Rucha. Thanks for that. Rucha is referring viewers, remember, to the US elections, because that's a large portion of what IT service companies' clientele factor in when they are taking these decisions. 9.7 in IT, Rajesh, just wondering, is it largely services even now, or do ER&D or product companies also come into the fray?
So Niraj, actually two parts to it. One is this 9.7% is at about 16 days back number. So now actually we have increased slightly a bit here, number one. Number two is one of the name, actually top 5 names or the services company, which we have actually prepared just before earning previews coming in itself. Just we have paid a bit, and we have actually taken down to 3.5-4% levels, because services we think at least will take another 2 quarters, because I think US Fed has to change its stance. Till that time, you might not see the sentiment turning positive for IT services as a segment. But we are actually, as you rightly mentioned, our focus is more towards ER&D as a segment. That particular space has actually very good growth runway over next 3 to 5 years perspective. So that is one segment we are positive. And another bottom-up name we have actually just been building in the portfolio. One of the second-rank IT company where change of management has happened, and historically this company has done multiple acquisitions. Now the new management has been actually just easing out a couple of those unrelated or actually the longer-term strategy segments that they have been easing out. So we expect this particular company will deliver quite strong set of numbers with the whatever change of strategy and change of leadership is happening in the business. For next 4-6 quarters, this company could give quite stupendous returns, as it is currently trading at a significant valuation to most of the IT services company. So that is one company actually just we are building position in the portfolios, and plus ER&D. This core IT services actually just we think it is at least another 2 quarters away in terms of any recovery. But most of these companies, as you are aware, I think valuations wise, they are trading compared to their historical multiples at a discount. But most of the actually negative seems to be in price already. And already we have seen TCS has reported strong set of numbers, whether it is in terms of margins, at least it is the highest in recent times at least. So you might see some green shoots, some kind of actually positive connotation coming out of these earnings, but we have not yet actually built forward positions there. But we are focusing more ER&D and this kind of actually just one of the satellite name we have added in the portfolio as a change of management and change of business model.
Okay, interesting. Strong margins for TCS for sure, viewers, but the commentary may be still some time away, maybe, which is why ER&D is the focus and not IT services necessarily, but certainly a pocket that one should monitor very carefully at some point of time. If growth returns, then in some stocks, the valuations possibly also might start to look interesting. But great. It is lovely talking to you, Rajesh. Thank you so much for taking the time out and being with us and giving us your thoughts, and all the best for the year.
Thank you. Thank you very much, Peter.
The pleasure was ours, and viewers, thanks for tuning in to this leg of the Portfolio Manager.